Guys, what's up and welcome to my YouTube channel. This is Male Green. If this is the first time you're coming across this channel, kindly subscribe, share and like my videos. So today's topic is going to be one of the statements of one of the financial statements, which is statement of profit or loss, or it's also known as the income statement. So we're going to be talking extensively on the income statement. We'll talk about the what is the income statement, the components that make up the income statement, and the purpose of the income statement. What does the income statement, what does it achieve? What does it seek to achieve? Why do we bother preparing the income statement? So as you all know, the income statement is one of the three major financial statements. We have three major financial statements in accounting, which is the income statement, also known as the P or L statement. And we have the statement of financial position, also known as the balance sheet. Then we have the cash flow statement. These are the three major financial statements that an accountant is supposed to prepare at the end of a period, and these statements are also used by auditors when they are preparing an audited financial statement of a company. So today, just because of time, we'll be looking at just the income statement or the P or L statement. So a profit or loss statement or an income statement is a statement that summarizes a company's revenue, the company's costs, and the expenses that is incurred by a company over a specific period of time, which can be monthly, quarterly, or annually. And it's used to assess at the end of the period if the company has made a profit or if the company has incurred a loss. So we're talking about the components of the financial statement. So I'm going to share on my screen, I'm going to share a statement of financial performance or a profit or loss statement. So this is how we're going to assess all the components of this financial statements. And then we'll look at the essence or the uses, or why do we need to prepare a P or L statement, which is a profit or loss statement. The income statement is made up of 5 sections. It has the revenue section, then a section of the cost of goods sold, then the operating expenses, and the operating income, that is the operating income before interest and tax, then the earnings before tax. So let's look at each section. So for the revenue section, we have the total sales. So the total sales, then less any returns or refunds or discounts or allowances. Then if you have any other revenue that the company does, you can add that. Then we have the total net revenue. That's the part for the revenue section. Then for the cost of goods sold, if it's a sales company that is into sales of goods, we have the goods purchased section. But if it's a company that is into manufacturing, we have the cost of the materials, the cost of labor. Those are the people that are directly involved in production. That is the wages and salaries of those directly involved in production. Then we have the overhead expenses. That is the expenses that is directly involved in the production of the goods, like transportation of moving, that is the cost of transportation for moving the raw materials directly to the factory. So that is the direct expenses. Then when you subtract your revenue, you subtract your cost of goods sold from your revenue, you have your gross profits. Then after that, you have your operating expenses. So these has to do with your administrative expenses, like we have advertising and promotion, we have bad debts, we have insurance, maintenance and repair. So those expenses that are not directly involved in the production of goods, that is your operating expenses. That is the expenses you incurred for running your business, your transportation costs and all, they are all under operating expenses. So you have the total operating expenses. When you subtract your total operating expenses from your gross profit, you're going to have the earnings before interest and tax. Then you have your finance cost. Your finance cost is the charges, like when you borrow money from the bank, the interest that you are being charged is your finance cost. So when you subtract your finance cost from your earnings before interest and tax, then you have earnings before tax. Then you subtract your tax expenses. For companies income tax, it is 30%. So when you subtract that from your earnings before interest and tax, then you have your net profit or your net loss. The purpose of the profit or loss statement. The first purpose is that, one, the profit or loss statement helps to assess the financial performance of an organization. It helps to know if the organization is performing badly or it's performing very well in terms of the financial aspects. If the company is making a very good profit, you say yes, the company is financially performing well. And if the company is making a loss, then you know that the company is not doing well financially, especially when it's not a company that was just set up within 5 years. It's a company that's been in existence for like more than 10 years and is still making loss consistently. Then you know that the company is not doing well. So it is used to assess the financial performance of the organization. And also another purpose of the statement of financial performance, or the P&L statement, is that it is used by stakeholders like the management. So management needs to look at the statement of P&L to assess if the company is doing well or not. Then it helps them to make decisions. It aids their decision making. Then also the creditors, they need to look at your financial statement, especially the P&L. They need to know the financial position of financial performance of your organization, so that they will know if they can give you a loan, if you are eligible for getting a loan. Then also other stakeholders that will need this P&L statement is the tax authorities. They need your statement of financial performance to check if your company is paying the right amount of tax or your company is evading tax, and they will know how to write to you and follow up. Then also the other use of the statement of financial performance is that it is used to make budgeting decisions. It helps in budgeting. So most companies, before they draw the budget, they'll check the financial statement over a certain period of time. They know what kind of expensive, what things to budget more or less. It gives them an idea of the expenses that is being incurred by the company and how much it's being incurred. So that is another purpose of the statement of financial performance. So we've come to the end of this video, and we really appreciate you for staying to the end of this video. So do well to watch and share my videos. And if you have not subscribed, what are you waiting for? Just click on the subscribe button and subscribe to my channel so that you get notified every time we post a video. And if you are a returning subscriber, thank you so much for supporting Milgreen. And for now, it's bye. Our next video will be coming up soon, and we'll talk about the other financial statement. So it's bye for now. Bye.